I'm Doris. I'm here to share with you about my stock account. Today I earned $1,695. Today, the Federal Reserve says a banking crisis could hit the economy. In my account today, SQQQ rose for 4.07% to $33.86. Right now, the net asset of my account is $74,489.59. Today, it rose for 2.11%. As for the market closed overall decreased when the Fed released its information about raising 25 basis points. The regional banks decreased the most out of all the industries. Dow Jones Industrial Average closed lower for 1.63%. Nasdaq closed negative 1.60%, and S&P 500 closed 1.65%. All of the industries closed lower. The U.S. stocks closed sharply lower on Wednesday, led by regional banks. The Fed announced a 25 basis point rate hike, while acknowledging that turmoil in the banking sector could further hit an already fragile economy. Treasury Secretary Janet Yellen will stress that bank owners and bondholders are not protected by the government. After a two-day meeting, the Fed raised interest rates by 25 basis points on Wednesday. The Fed was cautious about the recent banking crisis and suggested that the rate hike was drawing to an end. It is the ninth rate hike since March 2022. The Federal Overmarket Committee, which sets the monetary rate, said there is no guarantee of future rate increases, which will largely depend on data released thereafter. The FOMC statement after the meeting said, the committee will closely monitor the incoming information and assess the impact on the monetary policy. The Commission expects that some additional policy strengthening may be appropriate in order to achieve an adequately restrictive policy stance to restore inflation to 2% over time. The wording differs from the previous statement. Previous Fed statements have said consistently raising interest rates is appropriate for reducing inflation. This softening tone comes at a time when the banking crisis has raised concern about the stability of the system. The FOMC statement points out the possible impact of the recent banking crisis. The committee said, the U.S. banking system is sound and flexible. Recent development could lead to tighter credit conditions for households and businesses, and put pressure on economic activity, recruitment, and inflation. The extent of these effects is uncertain. The Commission remains highly concerned about the inflation risks. Despite warnings about the potential impact of the banking crisis, the committee unanimously approved a rate rise. They increased the target range for the benchmark federal funds rate has risen to 4.75% to 5%. The target range of the federal funds benchmark set mutual charge for overnight loans, but passes them through into many consumer debts, such as mortgages, auto loans, and credit cards. Forecasts released along with the rate decision show Fed officials expect terminal U.S. interest rates to peak at 5.1%, unchanged from the last estimate in December, suggesting most officials expect only one more rate hike in the future. Data released along with the statement shows that 7 of the 18 Fed officials who submitted the rate hike past dot plots thought the end of rate will be above 5.1%. Forecasts of interest rates for the next 2 years also show huge differences among Fed members. This reflects in a widespread forecast points for future interest rates. Still, the median forecast from the Fed official notes that the benchmark federal funds will fall by 0.8 percentage points in 2024 and by 1.2 percentage points in 2025. The FOMC statement completely deleted the statement about the conflict between Russia and Ukraine. Markets have been closely watching the Fed's monetary policy meeting over more uncertainty than the agency usually makes an interest rate decision. Earlier this month, Fed Chairman Jerome Powell said the Fed might have to take a more aggressive approach to curb inflation. But a fast-growing banking crisis frustrated any idea of a more hawkish move, and led to widespread belief that the Fed will cut interest rates by the end of the year. On Wednesday, FOMC members forecast interest rates, inflation, unemployment, and gross domestic product, underscoring the uncertainty over the policy path. Fed officials have also adjusted their economic forecasts. They slightly raised their expectations for inflation. forecasting 3.3% this year from 3.1% December. The unemployment rate fell a notch to 4.5%, while GDP growth estimates edged down to 0.4%. Officials' estimates for the next 2 years have changed little, despite simply cutting their 2024 GDP forecast to 1.2% from 1.6% in December. These predictions were made against a turbulent background. At a press conference later, Fed Chairman Colin Powell said, "A small number of banks are experiencing serious difficulties. The Federal Reserve, the Treasury Department, and the Federal Deposit Insurance Corporation had already taken decisive action. The depositors' savings are safe." Excuse me. But he warned, if the isolated banking problem is not addressed, the entire banking system will be threatened. Our loan program effectively meets the needs of the banks. The Fed will continue to closely monitor the situation and is ready to use all its tools to ensure the safety and soundness of the banking system. Mr. Powell said the U.S. labor market remained too tight, inflation remained too high, and the Fed remained strongly committed to pushing inflation down to 2%. He said, "Higher interest rates and slower growth are dragging down companies. Almost all members of the FOMC seek rates to growth are mainly to the downside." Mr. Powell said the wage increases showed some signs of easing. Inflation expectations appear to be under good control. Treasury Secretary Janet Yellen stressed on Wednesday that banking owners and bondholders were not protected by the government. Ms. Yellen planned to defend the Biden administration in Congress on Wednesday to boost confidence in the U.S. banks, and stressed that it was not available to the owners or investors of any failed banks. In a speech prepared for a Senate committee hearing, Yellen said, "It is important to make clear that shareholders and debt holders of failed banks are not protected by the government. The loss caused by the disposal process of these banks is not borne by the taxpayers." She added, "And the protection for deposits is provided by the Deposit Insurance Fund, which is funded by the premiums of the insured banks." On the budget, Ms. Yellen will respond to the government's request to grant an additional $14 billion to the IRS. Just a year ago, Congress had allocated an $80 billion to rebuild the IRS over the next decade. The budget we request will provide stable operating capital and will enable taxpayers to get the best service, Yellen said in her release, which will supplement the one-time long-term investment in the IRS. U.S. stocks closed higher on Tuesday, with the Dow up nearly 1%, the S&P 500 up 1.3%, and the Nasdaq up 1.58%. Invesco Global Market Strategist Brian Levitt said. U.S. stocks closed higher on Tuesday as investors were encouraged by easing concerns about the banking crisis and the growing probability that the Fed will nearly end tightening. He said, "The Fed's tightening cycle usually ends with a crisis. These crises often end in policy reactions that may help explain the market move." That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.